We're back again. Hi there, Allen Reminick here. Trades the future is what we're trying to do. And we were talking about a potential stock market crash last week. I wanted to follow up on that one because, everybody's wondering, and it's certainly developing at this point very much like we had expected. But I just want to give you additional feedback as to what we're seeing and what's likely to come forward. All right, so what we had happen was we expected a rally last week, and it was there. It went up till Wednesday, and it had a little dip on Thursday. It came back up on Friday. The question is it going to go higher on Monday and Tuesday, or is it finished, and is it going to turn around and die on us? Okay. So based upon the research that we've been able to establish is that there's a good chance that Monday still could be possibly one more up day, and that the market is very close to ready to turn down. To get it exactly correct is often almost impossible to do, but nevertheless, we're going to be waiting till Monday before we do anything. And it's likely that if you got into the position on Monday, even if it did go up again on Tuesday, the market's going to turn around fairly dramatically and go down consistently lower, so that even if you're not that precise about the entry, you probably do fine. Now, I wanted to go back to some of the charts, and there are two possible likely paths which the market could follow on the way down, assuming it does go down, which is starting to look more likely given Facebook's performance this week. It also died after Netflix the week before, and some of the other FANG stocks and some of the other stocks are starting to show signs of trembling a little bit. The internals in the larger market and the small caps are starting to look weaker. So there's nothing 100% definitive until it actually happens, but at this point it's starting to begin to look like we might see it. So the two patterns that we're looking at as possibilities, the first one, if you take a look at your chart right now, you'll see the high point here matches up with where we are in the present market. This is the present market. This is 1946 market. And it says that July 11th of 1946 is corresponding to February 4th of 2022. Notice what the market does. It falls now ultimately one leg down, and then it snaps back up again, and then it has the big decline. So the timing on this would be this pattern, which if it does it exactly, has already started down, and Monday would be lower. And then this goes down to roughly the 16th or 17th of February. And then it snaps back up, and this high here is between the 5th and the 9th of March, which we talked about as kind of historically one of those dates that shows up quite often in the S&Ps and in the broader market as a pivotal date. So if this pattern happens, we're not going to see a whole lot of profits until after, at least going short we wouldn't, until after the March high. And then this low would come in here in early April, and this last low here would come in late May, early June. And then we'd have a rally into, looks like September, and then down again into October, November. And then potentially the whole business is over for the year. So that's one pattern. And to support that, we had noticed that there were other markets that did very similar things. And one of them was the 1901 market. And I keep coming back to the 1901 market because, number one, there is a 120-year cycle that seems to show up in history, and natural law seems to use it somehow. And the other reason is that not only is it showing up as a good match on a 12-month basis, if you go back for 12 months, it's also unusual. It's showing up as one of the best matches if you go back only 2 months. In other words, it's been similar the last 2 months, it's been similar the last 4 months, and it's been similar the last 8 months. So it's been repeating very closely, not only on an average basis over 12 months, but also the short-term stuff is coming in very similar. And that is unusual. When you look at these pattern recognition programs, you very rarely find the same markets showing up when you use different time intervals like that, and this one does. What's also curious about it is the pattern that it does. If you look here, this is where we would be in the 1901 market, which would be roughly July 7th of 1901. It's 120 and a half, 120.58 years. Notice it goes down again and then snaps back up again, and then it has the big move, and it does very similar. Now you can see the upper graph here is 1901. The lower graph is that 1946 market, and you'll notice how similar they are. You have the down move, the up move, that down move, the up move, setting up the short. Then it has a nice, massive kind of break, and then it stays down there for a while. We have the same thing here in 1901, a nice big down move, which lines up with this one. Then a little up move and another down move, and it comes in again early June. Then we have a rally and another decline later in the year. Slightly different in here, but very similar. Same structure, goes up and back down to retest. So that is one candidate. The candidate is that basically the market's going to go down and back up into March, and then March will be a nasty decline, and then after that it would stay down until late April and bounce around until early June, and then take off for a couple months and then back down at the end of the year. Okay, that's one candidate. The other candidate was the more dramatic one, which everybody gets excited about, which may or may not happen, and this is also the 1901 market again, looking at it from a 3-month perspective. And what's interesting is it finds the same date almost exactly as it did in the prior one. That's extremely unusual. Working with these things for a while, you can see it isn't a normal phenomenon to see that happen. And this was the same thing on a 64 bar basis. Same pattern showed up again. Okay. Again, finding roughly the same date, within 1 day of the same date, and has 120 years of data to play with. So that's pretty interesting. Okay, so the other choice was the crash market, the crash pattern. And the crash pattern of 1929 and the crash pattern of 1987, basically they are still saying the same story, that market goes up possibly another day or two, maybe even longer, maybe even 3. And then February is the killer month. And February is where it just falls apart. And that February 16th or 17th area, which was a low in the first pattern, turns out to be kind of an acceleration point in the crash markets of 87 and 1929. And it just falls and falls and falls and falls and goes down, so that early March actually turns out to be the bottom of the crash. So there are two candidates. The dates are similar, but in one case we have a decline, but it's not huge in February. It goes down, possibly taking out the low of last month, but not dramatically lower. Then it goes up again into March, looking like it's recovering and maybe things are okay, and that's when the really nasty stuff happens. The other pattern, it goes down dramatically in February. It keeps on going. So we're going to basically take the idea that we want to get into a protective position with our long positions and get out of them, and we want to be shorting the market as heavily in early February as we would even if it weren't going to crash, because we won't have the ability, it won't take any prisoners if it does. And the other choice you make is around the 16th, 17th, 18th of February. If it looks like it isn't falling dramatically, you can get out of your shorts and wait for a rally and then do it again. That's another way to play this if you're interested in shorting the market. And if you're interested in getting out of the market, I think you should just get out of the market and not think about it too much, because even if it goes up a little bit more in March, it may not be much more, and then you have to sit through the huge risk that you might be seeing a waterfall type decline in February. So hanging on at this point, if you're choosing to get out, then don't hesitate. That would be our viewpoint on it. You can do obviously what you want. You have to take the risk. We can't, be responsible for the risk that you're choosing. but we're trying to support people's decisions by giving them as much tangible evidence from these areas of research that have been doing well over the years, and I find the reliability is quite good. All right, thanks a lot for your attention. Come back to our website and the YouTube channel. You'll see a bunch of other things coming in the future. We're looking forward to repeating this performance possibly on a weekly basis, where we talk about different markets and different conditions and situations, and hopefully the market will treat you very well. Thanks.